But before we dive into it, let's take a look at the disclaimer and the intro.
Okay, so welcome. Yeah, so actually, we are looking at market structure. So, market structure, this is basically the current condition of the market, whether the market is heading to the downside or heading to the upside. So, that's market structure. Yeah, and you need to understand what market structure is or the current condition of the market for you to be able to tell whether you should be buying, selling, or just completely staying out of the market. Okay, and market structure is basically characterized by higher highs, higher lows, lower highs, lower lows, and not forgetting break of structure, which is most of the time abbreviated as BOS or BOS, break of market structure. Yeah, so let's see understanding market structure. So, as I have said, this is basically the current condition of the market, and it helps you to know whether you should be buying, selling, or actually being out of the market. Because, like let's say, for example, in the physical business, there is a time you will wait for price to maybe skyrocket for you to take out your goods to the markets. You understand? Yeah. So the same case applies in forex trading. When the price is high, that's when you're preparing to sell the currency pairs or whatever asset you're trading. So let's say, for example, here we have this one here is our high. Let me see if I can mark it out. uh high. Okay, let me reduce the fonts a little bit. 16 is okay. Yeah, change the color just to for clarity. Red is good, eh? Okay, so we have that high. Then we have this one is a higher low. Yeah, higher low. Okay, so basically in this market condition, uh, the market is trending to the upside. Yeah, as you can see, the market is actually trending to the upside, whereby it's forming a series of higher highs, higher lows, higher highs, higher lows. Yeah, this is another higher high. We also have here another higher low. Okay, this is another higher low, and so on and so forth. Higher high, higher low, higher high, higher low. And the process of breaking the higher high or the highest high in the market, it forms what you call a break of structure. So that's a structure. It forms a structure. Yeah, the current condition of the market or the current structure of the market. So price coming from internal, I mean, from inside here, going up and breaking this structure is just self-explanatory, right? Because we are breaking a structure and we're calling it a break of structure. Yeah. So the other thing you need to understand about market structure, or basically about the price, is that price moves from internal to external liquidity. Yeah. So like here, for example, we had this move, this bullish move. We had this bullish move. Then we had this we call it a retracement. We had this retracement to the downside, then we had a bullish move. But before that bullish move, we had a formation of some liquidity here. Yeah, this liquidity is meant for the the next or the upcoming retracement. Yeah, so that's one thing you need to learn as a trader. That trade, I mean price moves from internal to external liquidity. Yeah. So let me delete this. Yeah, that's one thing you need to understand. Price moves from external to internal liquidity. So you need to be able, okay, as a trader, you need to be able to spot these liquidity points in the market. Yeah. Without you being able to spot the liquidity points, it will be hard for you to master these. Yeah. If you haven't yet watched my video on liquidity, consider watching. Yeah, I recorded the video last time. I already had posted it. So consider watching for you to understand, to be able to understand uh, how to spot liquidity on the market. Yeah. So the previous or the current high, like for example in this case, this one here is our current high, as you can see here. This one here is our current high. Yeah. So this high forms a structure. This high here forms a structure. But as you can see, we have an internal liquidity right below here. We have an internal liquidity here. Yeah. So we are expecting price as it does what you call retracement. As it retraces back, it now comes to clear this liquidity. Yeah. Then it gives us a confirmation for us to continue to the upside. Yeah. And we will be trading in line with the market structure. So in this case, okay, for experienced traders, they can sell and buy in a single market structure. Let's say in this case the market is trending to the upside, but for an experienced trader, we have what you call counter trading, whereby you can sell on a bullish market or you can buy on a bearish market. Yeah, but for that you need to really understand, especially the lower time frames. Yeah. So we have these breaks of structure, and we also have what you call good change of character. Yeah, we have another one called fake change of character, but you need to be able to utilize both. Sorry for that. You need to be able to utilize both. In both cases, you need to be able to trade. Yeah. Okay. So like here we know that we are bullish, then the market retraces. It reaches the discount level. For those who don't know the discount level, okay, we have using our Fibonacci. So the discount level, we have these the upper side of the Fibonacci, or the upper half, is called the premium, but the lower side or the lower half is called the discount. So here in this case we are bullish. We have broken this structure, then the market retraces. So you will want to buy at discount. Why? Because price is low. That I think it makes sense. Buying low, then selling high. So you will want to buy at discount. So price comes to this zone, then it forms a change of character, which we consider to be good. Then we yeah, we rally to the upside. So this is a good change of character. Then after breaking that structure, price then comes. So in this other case, the other thing you need to understand is that we also have internal market structure. Like in this case, you can see that we have these breaks of structure going to the upside, which symbolizes that we are bullish. or in other words, we are trending to the upside. But you can see these breaks of structure to the downside. So this one here is what we call internal liquidity. I mean, not internal liquidity, but internal market structure. So overall, we have market structure trending to the upside, but in this retracement, we have I mean, the internal structure trending to the downside. I don't know why I keep on saying liquidity, but anyway, okay, we have internal market structure trending to the downside. So for you to be able to know that now this internal structure has come to an end, we need to have a change of character, whereby we break the previous lower high, then we start forming a bullish structure. So in this case, this was our lower, I mean, lower low, lower high, lower low, lower high. Let me just mark them out. We have this lower low, lower high. We have this lower low, lower high. We have this lower low. Then, for you to know that the internal structure has changed, has turned bullish, we need to break this previous lower high. So we break it like that. So after it's broken, okay, after that previous lower high is broken, okay, sorry for that actually. After this previous, let me delete this. After this previous low high is broken, we now consider the internal structure to have turned bullish. Yeah. So then we wait for the break of structure. So we enter a buy trade here. In this case, we enter a buy trade at least at discount. Yeah, longs actually. We enter a buy trade with our stop loss just below this change of character. Then we target the previous high because you know that we are bullish. Yeah, and at least you need to have a risk to reward ratio that at least makes sense. Yeah, but anyway, I know of profitable traders who do trade 1:1 risk to reward ratio, 1:2 risk to reward ratio. But as for me, the risk to reward ratio that makes sense to me or works for me is 1:3. That's the minimum risk to reward ratio I can use. Yeah, so let's proceed. Okay, so now let's dive into the live chart or into the chart example of market structure. Yeah, so for example, here we have the market structure trending to the upside. Let me see this. This structure is trending to the upside, whereby you have a break of structure, break of structure, break of structure, then break of structure to the upside. So this simply shows that we are bullish because we have multiple breaks of structure to the upside. That means the current market structure is on an uptrend. So what do we look for? We look for buys. Majority of traders will look for buys. Yeah, you can look for buys maybe from order blocks or supplies and demands. Like in this case, you can look for buys from those zones. Yeah. So we have this break of structure, retracement, break of structure, retracement. Then we have this internal structure whereby have lower high, lower low, lower high, lower low, lower high, lower low, lower high. Let me just label it. Lower low, lower high, lower low, lower high, lower low, lower high. Then we have this change of character to the upside. Yeah, as you can see it. So As a trader, you need to be knowing the current market structure so that as you are trading, you remain or you are in line with the market structure. That will be at least favorable for you. Yeah. You need to be in line, always in line with market structure. Whether you are counter trading or you are trading with the trend, you need to be in line with market structure. And that will actually increase the probability of your trades. Yeah. So, yeah, that's it about market structure. If you enjoyed the video, be sure to give it a thumbs up, subscribe. Yeah, for this helps the growth of the channel. Okay. Without further ado, I think I'll stop it at that point. Yeah, kindly comment in the comment section below what you want to see me post. Yeah, I think I'll come to an end.